I made $1 million in a single day during the Great Crash of 1929, while others lost everything. That decision, to short the market when everyone else was buying, wasn't luck. It was the culmination of trading principles I'd developed over decades. In the next 50 minutes, I'll reveal exactly how I identified the crash before it happened, the specific signals I recognized, and the psychological discipline that allowed me to act when others froze. This single approach to market tops has generated fortunes across a century of market cycles. The market gives signals before every major move. I learned to read them through 4 devastating failures and 3 fortunes made and lost. Wall Street called me the boy plunger and the Great Bear of Wall Street for a reason. I understood market psychology better than the institutions themselves. In the summer of 1929, I saw unmistakable weakness while newspapers trumpeted a new era of perpetual prosperity. The divergences were clear to me: declining volume on rallies, deteriorating market breadth, and critical sectors failing to confirm new highs. These same patterns appear before every major market collapse: 1987, 2000, 2008, and even today. When I shorted that market, brokers called me insane. Banking executives publicly ridiculed my position. My own friends begged me to buy stocks. That psychological pressure, the weight of standing alone against the crowd, is what breaks most traders. I'll show you how I developed the mental framework to withstand it. The principles I used aren't theoretical. They're battle-tested across multiple market cycles and remain unchanged because human psychology never changes. Fear, greed, denial. These emotions drive markets today exactly as they did in my time. Most traders fail because they can't distinguish between price action and true market character. I developed a methodology to separate the signal from the noise, a system that identified major trend changes while others were caught in the emotional whirlwind of hope and fear. By October 24, 1929, Black Thursday, my positions were so profitable that I was making millions by the hour. Not because I was smarter, but because I had learned through painful losses to respect the market's message above all else. I promised to teach you exactly how I made these market-defining trades. I'll reveal my complete methodology for identifying major market tops and bottoms, the specific indicators I tracked, and the psychological discipline that allowed me to execute when others couldn't. The same patterns that made me millions in 1929 are visible in every market cycle since, if you know what to look for. Let me tell you about my early failures, the ones that shaped me before anyone knew my name. In 1891, I was just a 14-year-old kid from Massachusetts with $5 in my pocket, standing outside a bucket shop in Boston. I'd left school against my father's wishes, determined to make my fortune in the markets. Those New England bucket shops were my first classrooms. I'd watch the ticker tape, making imaginary trades, until I had the courage to put real money down. My first real trade netted me $3.12, more than half my capital at the time. I still remember the surge of validation I felt. By 15, I'd built that $5 into over $1,000, a fortune for a boy in those days. The bucket shop managers began to hate me. They called me the boy plunger because I'd dive into positions with total conviction. What they didn't realize was that I wasn't gambling. I was studying price patterns with religious dedication, but don't romanticize these early wins. Between 1891 and 1900, I went broke 3 times, completely wiped out. The first time nearly destroyed me mentally. I'd built $10,000 in capital, equivalent to over $300,000 today, and lost it all in cotton futures, my mistake. I confused my trading rules with my emotions. I'd developed a system that worked in bucket shops. Buy rising stocks, sell falling ones, cut losses quickly. Simple pattern recognition. But when I entered the legitimate exchanges, I started listening to tips, rumors, and worst of all, my own hope. The market doesn't forgive this confusion between facts and feelings. In 1897, I made the catastrophic error of averaging down, adding to losing positions. This is financial suicide dressed as opportunity. I kept thinking, it can't go lower, only to watch it drop further each day. By 1900, after my third wipeout, I finally understood what would become my lifelong principle. The market is never wrong. Opinions often are. I realized I wasn't failing because my pattern recognition was flawed. I was failing because I wasn't following my own rules with iron discipline. These early failures taught me that successful trading isn't about being right. It's about being disciplined enough to act on what the market is actually telling you, not what you hope it will do. Every dollar I lost in those New England years purchased knowledge that would later make me millions. Remember this: your early failures aren't wasted capital if you extract their lessons. Mine taught me that trading rules written in prosperity must be followed precisely in adversity. This discipline would eventually make me one of the greatest traders in history. By 1908, I had already experienced both spectacular triumphs and devastating losses in the market. Standing in my New York office that year, watching ticker tape scroll endlessly, I formulated what would become one of my most powerful trading rules. The market had taught me brutal lessons, and I was finally ready to learn. I noticed something critical about my winning trades versus my losers. When I entered positions based on clear, objective patterns rather than hunches or tips, my success rate increased dramatically. I began documenting every trade meticulously, analyzing what worked and what failed. The rule crystallized one afternoon as I watched Union Pacific stock. The price action formed a pattern I'd seen repeatedly, a consolidation after a strong uptrend. Most traders were selling, believing the move was exhausted, but my analysis showed accumulation, not distribution. I bought heavily while others sold. Within 3 weeks, Union Pacific surged 30%. This wasn't luck. It was pattern recognition. I realized I needed to trust objective market signals over emotions, tips, or conventional wisdom. The market doesn't lie when you know how to read it. My rule became simple but profound. Never take a position without a clear, objective reason for entry and exit. If I couldn't articulate exactly why I was buying or selling, and precisely when I would exit, I stayed out entirely. This discipline saved me countless times. In mid-1908, when a banking crisis triggered a sharp sell-off, I avoided panic selling because my rule demanded objective exit points, not emotional reactions. While others liquidated at the bottom, I maintained positions that recovered fully within months. The power of this approach comes from removing emotion and opinion from trading decisions. Markets don't care what you think should happen, they only reflect what is happening. By 1908, I had learned to align myself with price action rather than fight it. I tested this rule extensively that year across different market conditions. It performed brilliantly in both bull and bear phases. The consistency was remarkable. When I followed it strictly, my win rate exceeded 70%. When I deviated, disaster usually followed. What makes this rule timeless is its focus on observable evidence rather than prediction. I stopped trying to forecast market moves and instead learned to recognize them as they developed. This shift transformed my trading permanently. The lesson here is clear. Develop objective criteria for every position. Document your reasons for entry and exit before committing capital. When the market violates your criteria, exit without hesitation. This discipline, forged in the crucible of my 1908 experiences, remains as vital today as it was over a century ago. The psychology behind my trading rules isn't just some academic exercise. It's what kept me alive in the markets when others perished. My mental framework developed through blood and pain, not theory. I discovered early that the mind is the true battlefield of trading. When I lost my first fortune in 1901, I wasn't defeated by the market. I was defeated by my own psychology. I couldn't admit I was wrong. My ego wouldn't allow it. Let me share what I learned. The market doesn't reward intelligence. It rewards emotional discipline. When I made my greatest trades, shorting the market before the 1907 panic and again before the 1929 crash, I wasn't smarter than others. I simply controlled my emotions when they couldn't. My psychological framework rests on 3 pillars. First, I separate my identity from my trades. A losing trade doesn't make me a loser. It's just data. When I lost millions in the cotton market in Bahia Bate, 1908, I didn't spiral into self-doubt. I analyzed what went wrong, adjusted, and moved forward. Second, I embrace uncertainty. Most traders crave certainty. They need to be right. I don't. I'm comfortable admitting I don't know what will happen next. This allows me to change my position without emotional resistance. The market proved me wrong countless times, and each time I adapted rather than fought reality. Third, I practice detachment from money. When you're trading with fear of loss, you've already lost. In 1923, I made over $1 million in a single day shorting wheat. I didn't celebrate. I didn't even feel excitement. I simply executed my plan with mechanical precision. Here's the paradox most traders never grasp. To succeed, you must care deeply about your process, but remain utterly detached from outcomes. When I entered a trade, I focused entirely on execution, not on how much money I might make or lose. I developed rituals to maintain this mental discipline. Before major trades, I would sit in complete silence, clearing my mind of all expectations. I visualized different market scenarios and my responses to each. This mental rehearsal prevented panic when real money was on the line. Remember this: your greatest enemy isn't the market. It isn't other traders. It's the person staring back at you in the mirror. Master that person, and you've mastered trading. I lost fortunes repeatedly before I understood this truth. Don't make my mistake. Start with psychology, not strategy. The 1907 panic should have been my crowning moment, but it became my most painful lesson instead. I had correctly read the market's weakness. I had positioned myself perfectly for the crash. My short positions were primed to deliver the greatest windfall of my career. But I made a catastrophic error that cost me millions and nearly broke me psychologically. I violated my own cardinal rule. I listened to outside opinion. J.P. Morgan himself had begun orchestrating a market rescue, and the rumors swirled that the worst was over. The financial papers reported the panic would soon end. My broker, a man I respected, suggested I cover my shorts before the recovery. Instead of trusting my own analysis, the very system that had positioned me perfectly, I capitulated. I covered my shorts prematurely. Within days, the market plummeted further, exactly as my original analysis had indicated. The fortune that should have been mine vanished because I abandoned my conviction at the critical moment. This mistake cost me over $3 million, equivalent to roughly $90 million today, but the financial loss paled compared to the psychological damage. I had betrayed my own system at its moment of validation. Learn from my failure. The market will test your conviction most severely when you're most correct. The voices will be loudest, the pressure most intense precisely when your position is about to be vindicated. The final shakeout before a major move is designed to force you out of your position. I've developed a specific technique to combat this psychological pressure. I write down my complete market thesis before entering significant positions, the exact conditions that led me to the trade, the specific signals I'm watching, and most importantly, the precise conditions that would invalidate my thesis. Only those predefined conditions should force me out. Not rumors, not financial papers, not brokers, not even market legends. If the invalidation conditions haven't triggered, I stay with my position regardless of external noise. My 1907 mistake taught me that psychological discipline isn't about being stubborn. It's about creating systems that protect you from yourself. Your greatest enemy isn't the market or other traders. It's your own susceptibility to doubt at precisely the wrong moment. This principle has saved me countless times since. When I shorted the market in 1929, similar pressures emerged. But this time, I had my system. I held my positions despite the noise, and the result was the greatest trading triumph of my life. In 1908, I spent countless hours at the Boston Public Library, surrounded by financial ledgers and market reports. Not for entertainment. I was formulating what would become my definitive trading rule. I'd already made and lost fortunes twice by then. The pattern was clear. Spectacular success, followed by devastating failure. I needed to understand why. I pored over my trading journals, analyzing every decision. The answer emerged from those pages like a photograph developing in solution. My greatest losses always came from breaking my own rules, specifically from holding on to losing positions. The rule I developed was elegant in its simplicity. Cut your losses quickly. Let your profits run. This principle sounds obvious when stated plainly, but implementing it requires extraordinary discipline. I've watched countless traders nod in agreement with this rule, then promptly ignore it when their emotions take over. When a stock moves against you, your natural instinct is to wait for it to come back. You tell yourself stories. It's just a temporary setback. The fundamentals are strong. I'll average down. These rationalizations are poison to your capital. I learned to treat the market's message as sacred. When a position moves against me, I don't argue with it. I don't rationalize. I exit. The market is telling me I'm wrong, and I listen. During my study at the library, I calculated that had I simply followed this one rule consistently, I would have avoided 90% of my catastrophic losses. The mathematics were undeniable. The second part, letting profits run, is equally difficult. The temptation to take quick profits is overwhelming. You want to lock in gains, to feel the satisfaction of being right. But this approach caps your upside while doing nothing to limit your downside. I developed a corollary. Never take a profit until technical action dictates. Let the market, not your emotions, tell you when to sell. This system transformed my trading. By 1907, I'd made my third fortune, $3 million from shorting the market during the panic, precisely because I followed these rules with religious devotion. The beauty of this approach is its simplicity. You don't need complex algorithms or insider information. You need only the discipline to follow two directives: cut losses, let profits run. In that quiet library, surrounded by the ghosts of financial history, I finally understood that successful speculation isn't about being right. It's about being right enough of the time and ensuring your gains far outweigh your losses. The market's greatest weapon against you isn't price action or economic cycles. It's your own mind. I learned this in 1906 when I correctly anticipated the San Francisco earthquake's market impact, but still managed to lose money. Why? Because I second-guessed my own analysis. Psychology is what separates the amateur from the professional. When I sit in this office analyzing charts, I'm not fighting the market. I'm fighting myself. My emotions want me to take profits too early. My fear wants me to cut losses too late. My greed wants me to increase position sizes after a winning streak. I've developed specific mental disciplines that form the backbone of my success. First, I never argue with the tape. When I'm wrong, I admit it immediately and close the position. The market doesn't care about my theories or my pride. Second, I maintain absolute emotional neutrality. In 1907, during the banking panic, I made over $1 million shorting Union Pacific while others panicked. My advantage wasn't superior information, it was superior emotional control. I felt nothing as I executed my trades. No excitement, no fear. Third, I separate my identity from my trades. A loss doesn't make me a failure. A win doesn't make me a genius. They're just outcomes in a probability game I'm playing. This detachment allows me to think clearly when others can't. Fourth, I recognize that patience is a strategic weapon. Most traders lose money not from being wrong, but from being impatient. I wait for the perfect setup, what I call my pivotal points. When all factors align, I strike with conviction. The rest of the time, I sit on my hands. Fifth, I've trained myself to think in terms of risk, not reward. Before entering any position, I calculate exactly what I stand to lose, not what I hope to gain. This discipline saved me during the panic of 1910, when seemingly obvious trades turned into traps for the unwary. Remember this: your account balance reflects your psychological mastery more than your market knowledge. The patterns in your trading journal reveal your mental weaknesses. Study them as carefully as you study price charts. I've made and lost several fortunes in my career. Each time I was wiped out, it wasn't market conditions that destroyed me. It was a psychological failure on my part. Learn from my mistakes. Master your mind, and you'll master the markets. The doubling effect became one of my most powerful weapons during the early 1920s. After my spectacular success shorting the 1907 market, I began to refine this approach. When I identify a genuine market trend, I don't just take a position and hope. I systematically increase my exposure as the market confirms my thesis. Here's exactly how I implement it. When I enter a position and the market moves in my favor by a predetermined amount, usually 10%, I double my position. This creates a compounding effect that most traders completely miss. During 1920-1922, while most were still reeling from the post-war recession, I used this method to build substantial positions in the emerging bull market. I remember sitting in my New York office in 1921, watching U.S. Steel climb steadily. My initial position was 1,000 shares at $71. When it hit $78, I doubled to 2,000 shares. At $86, I doubled again to 4,000. By the time it reached $94, I controlled 8,000 shares. This geometrical progression multiplied my profits exponentially. The key insight most traders miss is this: the market itself tells you when to get aggressive. When a stock moves decisively in your predicted direction, it's confirming your analysis. That's precisely when you should increase your commitment, not when you're hoping for a reversal. During this period, I refined another crucial aspect of the doubling technique, knowing when to stop. I never double more than 3 or 4 times on a single move. The mathematics becomes too dangerous beyond that point. If you've doubled 4 times, you're holding 16 times your initial position. One sharp reversal could wipe out months of gains. I learned this painfully in early 1922 when I over-leveraged on wheat futures. I doubled 5 times, holding 32 times my initial position. When the market turned against me suddenly, the losses accumulated just as quickly as the gains had. I could have protected a fortune had I stopped at 3 doubles. The doubling effect works equally well in bear markets. During the 1920-1921 recession, I shorted Baldwin Locomotive in tranches, doubling my position as it fell from $138 to $91. Each leg down confirmed my analysis that industrial stocks were overvalued. Remember this. The doubling technique is not about blind aggression, it's about calibrated aggression. You're letting the market's own momentum guide your increased commitment. When you're right, be bold. When you're wrong, be gone. This approach transformed my trading during these critical years and laid the foundation for my greatest successes in the years ahead. The 24-hour rule gave me a psychological edge that most traders never develop. When I implemented this discipline in the 1920s, I noticed an immediate difference in my emotional state and decision-making clarity. The markets during that era were particularly volatile, not unlike today's environment, and this simple rule became my psychological anchor. I discovered that my best trades came after forcing myself to wait 24 hours before executing major positions. This wasn't just about timing. It was about creating mental space between analysis and action. During the 1920s bull market, I watched countless traders rush into positions based on tips or emotional reactions. I refused to join them. The psychological advantages were profound. First, the rule eliminated impulsive decisions driven by fear or greed. When the 1921 market began its upward climb, I felt the same excitement as everyone else. But instead of jumping in immediately, my 24-hour pause allowed me to enter with precision rather than emotion. Second, this waiting period gave my subconscious mind time to process information. I found that my brain continues working on problems even when I'm not actively thinking about them. Some of my most profitable insights about Union Pacific and other railroad stocks came during these waiting periods. Third, the rule built my patience muscle. Trading success isn't about constant action, it's about waiting for the perfect moment. By 1924, I could sit through market frenzies with complete calm, knowing my discipline would reward me eventually. Most traders never develop this capacity. Fourth, it reduced my trading frequency. Most traders overtrade, which benefits only their brokers. My 24-hour rule automatically filtered out marginal opportunities, leaving only the highest conviction moves. This alone would have made me profitable. Finally, the rule provided emotional distance from market noise. Wall Street in the 1920s was filled with rumors, tips, and manipulation. My waiting period allowed the initial excitement to fade, revealing whether a move had genuine strength or was merely manufactured. I remember watching American Can's price action in 1927. The initial breakout looked compelling, but my 24-hour rule saved me from entering prematurely. The stock pulled back sharply before its genuine move higher. Those who jumped in immediately were shaken out at a loss. The psychological edge of patience cannot be overstated. The market rewards those who can master their emotions, not those who react fastest. My 24-hour rule wasn't just a trading tactic, it was psychological training that prepared me for the greatest market opportunities of my career. The 1927 cotton market taught me one of my hardest lessons in speculation. I had been tracking cotton for months, meticulously charting its movements. The fundamentals were screaming at me. Severe crop damage in the South, dwindling inventories, and increasing mill demand. Everything pointed to higher prices. I began accumulating a massive long position in cotton futures. With each contract I purchased, my conviction grew stronger. My analysis showed cotton was severely undervalued, and I was positioning myself to capitalize on what I believed was an inevitable price surge. What I failed to properly account for was the power of market manipulation. Several large commercial interests had been quietly building short positions, and they had deeper pockets than I anticipated. They were determined to drive prices down despite the fundamentals. As I continued buying, they increased their selling pressure. The battle lines were drawn on the trading floor of the New York Cotton Exchange. I remember the tension in the air, the shouting brokers, the frantic hand signals, the desperation in some traders' eyes. I remained outwardly calm, but inside I was fighting for survival. The shorts launched their coordinated attack in October. Cotton prices began to slide, despite all logical indicators suggesting they should rise. I held firm, even adding to my position on the dips. The fundamentals cannot be denied forever, I told myself, but the market can remain irrational longer than you can remain solvent, a lesson I was painfully relearning. By November, I was bleeding capital daily. My equity was evaporating at an alarming rate. The pressure was immense, not just financially, but psychologically. Doubt began to creep in. Was I wrong about the fundamentals? Had I missed something crucial in my analysis? I faced the hardest decision any trader must make: admit defeat or risk complete ruin. My own rules dictated that when a position moves decisively against you, you exit. The market was telling me something my analysis had missed. I liquidated my position, taking a loss of over $3 million, equivalent to about $45 million today. The pain was excruciating, but the lesson invaluable. What I learned from this debacle reinforced my trading philosophy. Never fight the tape. No matter how convinced you are of your analysis, the market's action is the ultimate truth. When price action contradicts your thesis, respect it. The cotton corner crisis taught me that market manipulation is a reality you must account for. Even the strongest fundamentals can be temporarily overwhelmed by concentrated capital. Your timing must consider not just when you're right, but when the market will recognize you're right. The markets have changed dramatically since my day, but my 24-hour rule remains just as powerful in today's high-frequency trading environment. I've observed how the fundamental psychological patterns that drove markets in the 1920s continue to manifest themselves today, albeit through different technological mechanisms. Let me show you exactly how I would adapt my 24-hour rule to modern markets. In today's world, I would still wait for confirmation, but I'd recognize the time frames have compressed. For some highly liquid instruments like major Forex pairs or the S&P 500 E-mini futures, my 24-hour rule might become a 4-hour rule. The principle remains identical. Wait for confirmation before committing capital, but the execution adjusts to market velocity. When I trade cryptocurrencies, for instance, I found the volatility resembles the bucket shops of my era. The emotional swings happen faster, but human psychology hasn't evolved. Fear and greed remain constant. I would still apply my waiting period, perhaps compressed to 6 to 12 hours, depending on the specific digital asset's volatility profile. I've also adapted my rule to account for after-hours trading and global market interconnectedness. In my day, markets closed definitively. Today, Confirmation might come from overseas markets while U.S. exchanges are closed. I would incorporate these signals into my decision-making process, examining how Asian markets respond to American news, for example. For options trading, I would extend my rule to ensure I'm not simply reacting to gamma or vega fluctuations rather than true directional movement. The derivatives market creates noise that didn't exist in my time. I'd wait to see if the underlying asset confirms the option price movement before taking a position. One critical modern adaptation I've made, distinguishing between algorithmic noise and genuine market sentiment. Today's markets feature high-frequency trading programs designed to trigger stop losses and create false breakouts. I would filter these out by focusing on higher time frame confirmations and larger volume signatures. Remember, the essence of my 24-hour rule isn't about the specific time period, it's about emotional discipline. It's about removing yourself from the heat of the moment and allowing market forces to reveal their true direction. Whether you're trading Bitcoin, Tesla options, or Treasury futures, the psychological principle remains unchanged. Patience creates profits. The technology has evolved, but human nature hasn't. My adapted 24-hour rule works precisely because it acknowledges this timeless truth. The market will tell you when it's ready to move. Your job is simply to listen and wait for confirmation before acting. While I've hammered home the importance of my 24-hour rule, I'm not dogmatic about it. There are specific situations where I'll break my own rule, calculated exceptions that have saved me millions. Let me share them with you. First exception, catastrophic market events. During the 1929 crash, I didn't wait 24 hours when I saw the market break key support levels. The velocity of the decline told me everything I needed to know. When panic selling begins and fundamentals no longer matter, waiting becomes more dangerous than acting. I liquidated positions immediately and went short, a decision that made me millions while others were wiped out. Second exception, when you have definitive inside information, legal of course. In 1907, I received reliable intelligence about a major bank's imminent failure. The information came from an unimpeachable source. I didn't wait 24 hours. I acted immediately, shorting the market aggressively. Had I waited, the opportunity would have evaporated. Third exception, when your position is already deeply underwater. If you're down 25% or more, the 24-hour rule no longer applies. The market has already proven your thesis wrong. In 1908, I held on to a losing railroad stock, positioned despite mounting evidence against my thesis. My stubbornness cost me dearly. I should have exited immediately when the position crossed my predetermined loss threshold. Fourth exception, when liquidity suddenly dries up. In 1920, I watched volume collapse in several stocks I was trading. The bid-ask spreads widened dramatically. This isn't time to wait. It's time to exit while you still can. Liquidity crises develop rapidly, and positions that were easy to exit yesterday become impossible to unload today. Final exception, when your physical or mental state is compromised. In 1922, I made catastrophic trading decisions while exhausted and emotionally drained. I've learned to recognize when my judgment is impaired. If you're not sleeping, if you're emotionally unstable, or if you're physically ill, close your positions and step away. The market will be there tomorrow. Remember, these exceptions aren't excuses to abandon discipline. They're specific scenarios where the 24-hour rule creates more risk than it mitigates. The true skill lies in recognizing the difference between panic and prudence. I've paid millions in tuition to learn these distinctions. You don't have to. The psychological edge in trading isn't some mystical concept. It's a practical advantage I've harnessed throughout my career. I've found that allowing 24 hours to pass before making major trading decisions completely transforms outcomes. This single practice has saved me millions and built my fortune when properly applied. I discovered this principle after a particularly devastating loss in 1907. I'd made 6 consecutive incorrect trades, each one executed within minutes of receiving new information. My emotions were driving my decisions, not my analysis. After losing nearly half my capital, I implemented the 24-hour rule and never abandoned it again. When I receive market-moving information, I force myself to wait a full day before acting on it. This creates 3 distinct advantages. First, it allows my emotional response to subside. The initial rush of fear or greed clouds judgment more severely than most realize. I've watched countless skilled traders ruin themselves by acting on immediate emotional impulses. Second, it provides time for additional information to surface. In 1929, news broke about a bank failure that seemed catastrophic. Most traders panic-sold immediately. I waited 24 hours, during which contradictory information emerged, showing the bank's problems were isolated. While others sold at the bottom, I maintained my positions and preserved capital. Third, it forces me to thoroughly analyze potential trades from multiple perspectives. During this waiting period, I deliberately argue against my initial reaction, seeking reasons why my instinct might be wrong. This process alone has prevented dozens of devastating mistakes. The market doesn't reward impatience, quite the opposite. I've observed that rushed decisions almost always underperform deliberate ones. When I compare my pre-24-hour rule performance to my results after implementing it, the difference is staggering. My win rate increased by 38%, and my average profit per trade nearly doubled. This isn't mere theory. During the 1921 market crash, I watched as traders frantically liquidated positions within minutes of price drops. I waited 24 hours, analyzed the situation dispassionately, and identified specific sectors poised to recover quickly. This patient approach allowed me to buy quality assets at fire sale prices while others were still reacting emotionally. The 24-hour rule doesn't mean inaction, it means deliberate action. During this waiting period, I'm actively researching, analyzing, and preparing. I'm simply delaying the final execution until my mind is clear. Master this psychological edge, and you'll immediately separate yourself from 90% of traders who remain slaves to their immediate emotional responses. The 24-hour rule, I developed decades ago, remains just as vital in today's lightning-fast markets. In fact, with algorithmic trading and instant information, my discipline-focused approach is even more crucial now. I've watched countless modern traders destroy themselves by abandoning the fundamentals that never change. Let me show you how I'd implement my 24-hour rule in today's environment. When I spot a potential trade setup now, I still force myself to wait 24 hours before execution, despite the temptation of one-click trading. This cooling period allows me to evaluate whether I'm acting on solid analysis or merely reacting to market noise. In modern markets, I'd maintain a separate digital journal specifically for these 24-hour considerations. For each potential trade, I document my initial thesis, expected price targets, and, most importantly, my emotional state. This creates a record I can review to identify patterns in my decision-making process. I found that modern traders face even greater psychological challenges than I did. The constant bombardment of information, social media, gurus, and the gamification of trading apps all conspire against disciplined execution. My 24-hour rule cuts through this noise, forcing a return to fundamentals. When trading cryptocurrency, which didn't exist in my day, I'd be even more rigid with my rule. These markets trade 24/7 with extreme volatility, making emotional control paramount. I'd extend my rule to 48 hours for initial positions in these markets, given their speculative nature. For options trading, I'd implement my rule with particular attention to time decay. My 24-hour consideration would include calculating precisely how theta would affect my position during that waiting period, accounting for this cost as part of my decision framework. The advent of mobile trading presents a unique challenge to my methodology. I'd address this by deliberately creating friction in my process, keeping analysis on my desktop computer while only executing trades after this mandatory separation. Modern market circuit breakers and trading halts actually complement my approach. These forced pauses in market action provide exactly the kind of cooling period I advocate. I'd use these moments to reassess, not to frantically plan my next move when trading resumes. Remember, the technology and vehicles may change, but market psychology remains constant. The same fear and greed that drove markets in my era drive them today. My 24-hour rule is fundamentally about mastering these emotions, making it perhaps even more valuable in today's hyperactive trading environment than it was in my own time. Patience isn't merely a virtue in trading. It's the foundation of survival. Throughout my career, I've watched countless traders destroy themselves by forcing trades, jumping at every market twitch, desperate to be in the action. I don't trade for action. I trade to win. My greatest trades came not from brilliant analysis, but from disciplined waiting. In 1907, as the market began to crack, I sat for weeks watching patterns develop, resisting the urge to short too early. When I finally made my move, I made millions while others were wiped out. Patience gave me clarity when panic consumed others. I've learned that the market will always be there, always. Missing an opportunity means nothing. Another will come. But losing capital means everything. It can end your career. I've gone broke multiple times by forgetting this fundamental truth. Each time I rebuilt, I reinforced my commitment to patience. The hardest lesson I've learned is that being early is the same as being wrong. In 1929, I saw the crash coming, but waited until the patterns confirmed my thesis. That patience turned $3 million into $100 million. Had I moved weeks earlier, I might have been squeezed out of my position before the collapse. I've developed a method I call stalking the market. I identify potential opportunities, then wait, sometimes for weeks or months, until all conditions align perfectly. When they do, I strike with conviction. This approach requires emotional discipline few possess. The urge to act is powerful, especially when you see others making money. During quiet periods, I've learned to study, reflect, and prepare rather than force trades. These periods of inactivity are not wasted time. They're investment in future success. My biggest losses always came when I abandoned patience. Remember this: the market doesn't reward activity, it rewards correctness. I've made more money sitting still than I ever made rushing into trades. If you take only one lesson from my life, let it be this: develop the patience to wait for the perfect setup, the courage to act decisively when it arrives, and the discipline to do nothing until then. This trilogy of patience, courage, and discipline has been my legacy to the trading world. The secret isn't in knowing more than others, it's in behaving better than others. And patience is the behavior that separates the survivors from the casualties.